Okay, hello everybody. Welcome to the second video of my new taxation policy for the US government. In this video, I'll address my idea for a new taxation policy. Remember, in the first video, we talked about the difference between current US taxation policy and, say, European taxation policy, just to show how European governments are able to offer more generous medical coverage to their citizens, more generous leave, in some cases, fully paid for tuition to private to colleges, etc. And bottom line from the first video is that European governments can do that because they tax their people more. Of course, here in the United States, we used to tax our people more. Back when we had a robust middle class after World War II, and for the next 30 years or so after that, tax rates in the United States were quite high, particularly for rich people. We would tax wealth in this country, wealthy people, up to about 90% of their income. Of course, today that's 37% for just personal income. And so, that was quite a bit higher. And that really high tax rate that we had back in the 1940s and 50s and 60s and into the 1970s was what allowed our government to provide a lot of stuff for citizens. For example, that's when we built the national highway system. And we were able to do that because the government had money because it was taxing people pretty heavily. And Europe is able to offer the benefits they do now, European governments, because they tax their people pretty heavily. And we compared our taxes with theirs, like our personal income tax tops out at 37% currently. Theirs tops out around 50% for most European countries. They tax businesses up to 50% of their profits. We tax businesses normally up to about 21% of their profits. They usually treat capital gains as regular income. We don't. We have a separate capital gains income calculation where most capital gains are taxed at around 20%. And of course, we have a very, very high deductible for estate taxes, and they don't. Their deductible for estate taxes is quite small compared to ours, so their governments get a lot more money from estate taxes. By the way, estate taxes were the original tax here in the United States. Before there were income taxes here in the US, there was estate tax and used to be pretty heavy. So anyway, I have here a proposal, and it goes on for a while, so this is just the first part of it. A proposal to radically change the way we tax. And the proposal is designed to do two things, to fix two problems. One is the problem of our budget deficit. We run a substantial budget deficit now every year of close to $2 trillion. And that's just not sustainable over the long run. Every year we add $2 trillion to our national debt, which is already at $40 trillion. Every year we have to pay the interest on that debt, where we're already paying $1.2 trillion a year just in interest. And if we keep adding to the debt, we keep adding to that interest payment, and eventually, most of the government's money is going to just paying the interest on the debt. And the government doesn't really have money for anything else. Like even today, 20% of government revenue goes to paying the debt. And if we keep going where we're going, eventually it's going to reach 50%. And at that point, the government really can't function in any meaningful way. And certainly can't pay off like the existing social insurance programs like Social Security and Medicare. Those would, be massively cut. So again, my proposal, the proposal in its entirety is designed to raise revenue for the government, to increase revenue. So more taxation. And I'm trying to do it in a fair way. So the second part of the proposal is to restore some fairness to the tax code, whereby rich individuals and rich companies pay more of their fair share in taxes, because currently they just don't. Rich individuals and rich companies actually manage to shield most of their wages and income from taxation. So you end up with a situation where, these we're just not getting much from wealthy folks and wealthy corporations, and I just don't think that's fair. So this proposal is designed to redress the unfairness of that, and in the process to generate more income. And the income primarily comes from increased taxation on rich folks, although some of these taxes will hit folks in the middle and lower middle class too. So let's get started, because this is quite an operation. My proposal, again, is very radical. It would involve radical changes to the tax code. Some of these things would no doubt be challenged in court. Some of them actually run afoul of state taxation rules. And so there would be probably Supreme Court challenges of states' rights versus federal rights on some of these. And so not going to pretend for a second that it's easy to get here. It would be actually really challenging to get here, even if more liberal folks took over the presidency and the houses of Congress. But I wanted to, give you this whole proposal just to maybe generate some ideas that you might have for how to fix some of these problems, because we have to fix the debt and deficit problem. And, I would like to also fix the unfairness problem, because it makes me mad, and I know it makes a lot of other people mad too, to see rich folks and rich companies get away with paying almost no tax, and a much lower percentage of what they've got in tax than like I pay. And I ain't rich. So let's get started. I've divided this up into several sections. The first is basic changes to personal income tax. So personal income tax, that's, the wages, the interest you get on account interest, CD interest, bond interest. Those are counted as regular wages now, and I would still do that. Gambling winnings above a certain amount, lottery winnings above a certain amount, stock dividends, which are also counted as basic income, and annuity payments. So all that is wages. Now, in our current U.S. tax scheme, we separate the wages, we have that on one scale, and then the capital gains, which we put on a different scale. Realized capital gains are income you get when you sell a capital asset like property or stocks or stock funds. Currently, we don't tax capital gains until the gain is realized, which is when you convert the gain into cash when you sell the capital asset. But I'm changing that. I'm not giving capital gains its own separate tax rate, because currently the capital gains tax rate really tops out at 20%, whereas the wage tax rate tops out at 37%. To me, that's a fairness issue right away, because it's saying basically that the government and the system values investment income more than it values work income, which is, to me, an insult to workers. Basically, it's saying, we're going to take more from you if you work for a living than if you just sit around and live off, the interest, or live off your, capital investments by selling them periodically, or selling some of them periodically. That's just, to me, it's really not fair. And so what I'm doing is, the first radical thing I'm doing is I'm putting capital gains in with regular income. They're going to be taxed on the same scale. The only concession I'm making to this is I'm allowing a separate deduction for capital gains, which is separate from the deduction you get to take just from your regular wages. And that addresses something that I hear. It's an argument that I hear from conservatives every time this comes up, putting wages in with capital gains on the same scale. They always say, well, what about elderly folks who are living on their investments? And to some extent, that's really not a very valid argument. I mean, it is valid in the sense that elderly folks who are retired don't tend to have as much wage income, and they do live more off of investments, but they tend to actually live off of interest-bearing investments, and and things like retirement, retirement accounts and stuff, and those actually are taxed at regular rates, even currently under the current system. So, I'm not sure I really buy that most older folks are living off true capital gains, which is, what you get when you sell things, that they're like selling some of their stock every year to finance their lifestyle. I know that some of them do that, but I don't think most of them do that. So in any case, to address that, like elderly folks who have to sell stuff in order to just maintain their lifestyle because they're not earning a wage, I put in that separate $50,000 deductible for capital gains. So what that means is you can, sell stock up to $50,000 in gains and not pay any tax on it. So you get the first $50,000 of capital gains free, basically, of federal tax. And I think that addresses that issue. I also am allowing people some standard deductions, and I'm actually raising the standard deduction. Currently now, the standard deduction for federal tax is like $15,000 per filer, and there's I think a $3,000 per child deduction. This is dependent children who live at home and usually under 18. So I'm raising that to 25,000 deduction with 5,000 per child also deduction. Now, all of that I've told you so far is actually lowering tax income. So the one thing here that's raising tax income a bit is I'm putting the top tax rate at 40% instead of the 37% that it is now. But I'm also stretching out the lower bands of the tax rates. So we're still doing marginal tax rates where you're taxed a lower amount on lower wages, and then as your wages go up, the amounts above those lower amounts that you earn get taxed a bit higher. A lot of people have the misunderstanding that, it's like if they earn $75,000 and that's a 15% tax bracket up there, that their entire wage is going to be taxed at 15%, but that's not how it works. We have a marginal tax rate, which means, the first $50,000 you earn is taxed on my system at 10%. Even no matter how much you earn, even if you earn $1 million, the first 50,000 is taxed at 10%, and then the next 50,000 is taxed at 15%. So if you earn 75,000, your first 50,000 would be taxed at 10, and then the next 25,000 that you earned would be taxed at 15%. So that's the marginal tax rate. That way, you don't get to the unfairness where if you earn 50,001, your entire income is taxed at 15%. If you earn 50,001, only $1 is taxed at 15%. The rest of it's taxed at 10. Okay. And then I put in some standard specific deductions like business losses, investment losses. These are things you can use to subtract from your personal income for tax purposes. Education expenses up to $10,000 a year. Charitable giving, uncovered medical expenses, mortgage interest only up to $100,000 a year and only on your primary residence. And then the one extra thing I've put in here under specific deductions is rent, because again, fairness issues. To me, it's not fair that, when people buy a house, they get to deduct their mortgage interest from their income, but renters don't get to deduct anything. So I put in rent like up to about 24,000 a year. Some people pay a lot more, especially in my area right now. People pay a lot more than that in rent. But the first 24 would be a deduction. So anyway, even though this goes up a little higher, and I've put capital gains in with regular income, I'm not sure overall how this is going to work out as far as, will it get extra revenue for the government or less revenue for the government? With putting capital gains as regular income and taxing it up to 40%, I know for richer folks, it's going to be more. They're going to be paying more in tax because richer folks do tend to get more of their income as capital gains. And when they do get capital gains, when they sell assets, they tend to sell much more valuable assets. And so those can be hit now with an up to 40% tax, whereas before they were only hit with a maximum 20% tax. So this will be more taxes for richer folks, but a lot less actually for folks who are poor, folks who are renting, folks who are just kind of barely making it. This is actually significantly lowers their tax. Now, as far as capital gains go, I'm talking about realized capital gains. That means the tax you pay when you actually sell the capital asset that you own, like when you sell a stock or you sell a house. So treat it as regular income with its own separate $50,000 deductible. Capital gains are calculated for stocks, stock funds, REITs, real property, and also private equity investments. A lot of rich folks tend to put a lot of their money in private equity investments. So we're going to make sure those are counted. We're not going to miss those. There are a lot of different kinds of private equity investments, and I didn't have the wherewithal here to list them all and talk about each one. That's just sort of beyond the scope of this. But pretty much any private equity investment, you're going to have to track its value from purchase on to sale. So you can calculate a capital gain there. Now, I'm taking out things like vehicles. You don't have to pay capital gains tax on vehicles you sell, even if it's like a plane. Now, why did I do that? Well, because in most cases, you're not going to have any capital gains on these things. These are what are called depreciating vehicles, are depreciating assets, which means that, like, with cars, as soon as you drive the car off the lot, it's worth less than what you paid for it if it's new. And remember, capital gain is only the increase in value of the asset. So all of these things, even a Gulfstream plane, once you spend a little time riding it, it's not worth what it was when you bought it. If you buy it new and then you use it to fly across the country a few times, it's not worth what it was. So the reason I took vehicles out is very few vehicles actually increase in value over time. They usually decrease in value over time. So this would actually, if I put this in as a capital gain, you would also have to put it in as a capital loss, which means I would be able to take the depreciation on all these things to offset my income, which would actually lower the income of rich folks. It would lower the taxes of rich folks. So, I took vehicles out. We're not doing vehicles for capital gains purposes. We're also not doing collectibles for capital gains purposes. And that includes things like jewelry and coins and stamps and artwork and antiques, all that. Some of those things will appreciate over time. Some of them will depreciate. The only time you have to value these things in all my tax scheme is when there's an estate sale. I mean, when somebody dies and leaves an estate. If you have some of these things that are worth more than a certain amount, then you would have to count them for the estate value. But otherwise, we're just not counting that stuff for anything, including capital gains. Okay, capital gains you have to pay off in the year that things are sold. And capital gains are valued back to either the purchase price or the most recent unrealized gains assessment, and we'll talk about that. That's my brand new tax. And realized capital losses can just be deducted from the current year taxes. In other words, you can't do what they often allow you to do now, which is take a personal loss and spread it out over several years. So like if I lose $10,000 this year, I spread it out over the next 10 years at a $1,000 loss a year. I'm not allowing people to do that anymore. This is one of the ways, by the way, that Donald Trump got away with not paying any taxes for a long time. He had one really bad year where he had a lot of business and capital losses, and he ended up spreading that bad year out over 10 years, didn't pay any taxes for the next 10 years, even though he owed taxes in those years. He ended up not owing because he was able to deduct part of this loss. And so I'm saying you can only deduct the losses in the year that you incur them. So when you sell at a loss that year, you have to deduct the loss. You can't spread it out. Spreading out is one of the ways that rich folks actually get away with not paying taxes for quite a long time. Okay, so those are the personal income tax changes. Again, the big thing here is you can deduct rent, part of your rent, which you can't do now, and treating capital gains as regular income with their own separate deductible. That's the big change, and those changes actually help also larger standard deductions. These changes help poorer folks and hurt richer folks, basically. So again, I'm trying to address some fairness issues here. As far as the extra revenue for the government, I think there will be a little from treating capital gains as regular income, but it's hard to calculate. Okay, so now let's get to something which I know is going to increase government revenue, and it's really radical. And that's the way we calculate business taxes. So I want to change how we calculate business taxes, and I want to change it radically. Big change here. The United States government and pretty much every government in Europe taxes businesses based on their profits. So a business in every year has to calculate its revenue, its income, and then subtract its losses. And businesses can count all kinds of things as losses, and they can do like depreciation of assets and amortizations and all kinds of stuff, which makes this calculation actually very complicated. Calculating an actual profit for a large business is really complicated because there's various sources of income and there's a whole lot of different sources of loss that you can stick in there. Some of those sources of loss actually make it fairly easy to sort of hide profits. And so I don't want to do that. I want to simplify this and in a way that's going to not kill business, but have businesses pay more of their fair share in taxes to the US government, particularly large businesses. Okay, so we are no longer calculating businesses, we're no longer taxing businesses based on their profits. Forget it, no profits, which means you don't have to do the income loss calculation. You just have to do the income calculation because we're taxing businesses on their gross income. Now, business owners are going to scream at this because they're going to end their argument's going to be right away, well, what if my business lost money this year? You're making me pay taxes and I have to take the loss? And the answer is yeah, to some extent. Yeah. Because if a business, let's face it, if a business keeps losing money year after year after year, it probably shouldn't be a business, right? not a good business. So, and it should be able to handle this kind of tax for a few years of loss, assuming the business ultimately becomes profitable. So how are we going to do this? Well, all the business is going to have to do is calculate its gross income. How much money it made from all the sales it did, and how much money it made from like interest on investment interest on its extra money. A lot of big businesses, they have extra money lying around, and so they tend to invest it to earn some more money on the extra money they have. And so that's part of their earnings is, what they get in interest on their investments. But then also, of course, their sales. So for US based companies, this tax is going to be 10% on their total business income, and that includes domestic sales and foreign sales. So wherever they sell anything in the world, they get a 10% tax, and plus their return on investments, their investment interest income. All of that is their gross business income, and they're going to be taxed 10% on that. Now, 10% is lower than the 20% profits tax we have now. But of course, we're not taxing profits here, we're taxing income, which can be a lot more than the profit. So most companies, particularly large ones, are going to end up paying more tax this way. For foreign companies, we're just going to tax at 10% what they sell to the US folks, so what a foreign company sells domestically. For example, the Mercedes company, which is based in Germany, we're not going to tax them on the cars that they sell to Germans. We're going to tax them on the cars they sell to the US and US-based companies. And of course, we're going to tax them on investment income, but only the investments they make here. So, if they invest in the foreign markets, we're not going to tax a foreign company on foreign investments. Okay, but if they invest in US companies or US markets, then we are going to tax them 10% on that, on whatever they earn from that. So interest earnings on domestic investments and sales, domestic sales, US sales. That's what we're going to tax foreign companies on. Now, we are going to have a deductible for business income. It's going to be too small to matter for large businesses. Businesses with revenue of $1 billion, this is insignificant. But, small businesses, this hopefully will help. We're going to have a deductible of $250,000 a year. I'm not married to that number. I'd be willing to make it higher, maybe 500,000 or something. But for now, I'm just putting down 250,000 a year. And so if a business has gross earnings, if it's a really small business, or it's a just getting started business and it has gross earnings of 250,000 a year or less, we're just not taxing it. We're only taxing amounts above that. So if a business earned, let's say, $1 million a year, it would be taxed on 750,000 of that, and it would be a 10% tax. So it'd be a 75,000 tax, federal tax on $1 million worth of earnings. Okay. And there's some restriction here on state taxation. That probably would be challenged in court and might lose because it might step on sovereign rights of states. But okay, again, I'm not wedded to that part. Now, I would only put in 2 business deductions, 2 allowable deductions, and that's it. One deduction for increasing the US workforce. So if businesses start hiring more US workers, I allow them to reduce their taxation rate or increase their deductible rate for that. And if businesses do what's called waste or energy mitigation, which means they reduce the amount of either the total amount of energy they use significantly, or they reduce the waste that the environmental waste that they produce. Environmental waste can be gases or toxic gases or gases that contribute to climate change, like methane, let's say, or it could be liquid waste that's dumped into rivers or the ocean, or it could be solid waste that has to be put into special landfills, whatever. all that is waste. And so businesses will have to sort of calculate if they want to take advantage of this. They'll have to calculate their waste and energy usage, and then if they can mitigate those things, they get a significant tax break. But those are the only deductions. That's it. And I know what you're thinking. You're thinking, well, what about depreciation and amortization and this and all the things that go into EBITDA, what they call EBITDA, which is currently how you calculate profitability on private businesses. But again, because we're not calculating profits, we're not taxing on profits. Those calculations are normally done for profit assessment, and we're not doing profit assessment, so no need to calculate it. This is dramatic, and we're not also going to have it as a deduction because it's not part of the taxation. So this is really radical, right? Very, very radical. Businesses won't be happy. A lot, especially large businesses, which will have to pay more tax. I'll give you a couple of examples here. I think last year, Facebook, which is a US company, earned total globally about 1.17 billion in total revenue, I think. No, they earned 11.7 billion in total revenue last year, I believe. And they ended up paying about close to 8 billion in taxes, which may seem like a lot, but it's 8 billion out of, no, sorry, I did that wrong. They earned, I'm getting my earnings mixed up. They earned 117 billion, not 11.7, not 1.1. They earned 117 billion globally, Facebook, last year. Whole year earning over $100 billion. They paid about 8 billion in taxes. Now, 8 billion in taxes to the US government, that may seem like a lot, but if you do the calculation in your head, 8 billion out of 117 billion, that's about 7%. Which is what they paid in taxes, 7% of their earnings. Now, I'm guessing you might very well have paid a lot more than that, more of your wages, of your income, than 7% to the government. So it's likely that Facebook paid less to a lower percentage of their earnings to the US government than you did last year. And Apple Computer is even worse. Last year, Apple Computer made about 400, or their total revenue, this is not their profit, just their total revenue, was about $420 billion with a B. 420 billion, that's almost $500 billion that Apple made in 1 year. I'm sorry, that they earned in 1 year. Again, not profit, total earnings, but still $500 billion earnings in 1 year. So what did they pay to the US government out of their $500 billion? They paid 13 billion. To the US government. Does that sound like a lot? Well, 13 billion out of 420 billion is 3%. So almost exactly 3%. So Apple paid 3% of its earnings to the government. I know that probably almost all of you paid a higher percentage than that. Like I paid, I think, 12%. So as a percentage of earnings or income, Apple paid 1/4. Apple Computer, which sells $500 billion worth of stuff a year, they paid 1/4 of the tax rate that I did. And that's just crazy unfair, in my opinion. So under my scheme here, Facebook would have paid, instead of the 8 billion that they paid, last year they would have paid, 11.7 billion. So closer to $12 billion of their revenue. And they would have paid 12 billion in taxes last year to the US government instead of the 8 that they paid. And Apple Computer, much more dramatic, they paid 13 billion to the US government last year. They would have paid 42 billion because they earned $420 billion last year. So they would have paid 42 billion instead of 13, which is much more in line. It's a lot closer to what I paid. I paid like 12, 13%. Apple would have paid 10%. of their revenue. So that's still maybe not entirely fair, but a lot fairer and a good windfall for the U.S. government. If you look at all this together, and the next thing we're going to talk about, businesses are going to end up paying a lot more of their fair share, particularly large businesses. Now, businesses here, I've got businesses with 10 employees or more, have to contribute to IRAs that their employees set up. Now, employees will have a choice of whether they want to set up their own retirement accounts or not. They could choose not to. If an employee chooses to set up a retirement account, then they have to, the expectation is they're going to make regular contributions to it. And so the business that employs them will have to contribute up to $2,500 a year to match whatever the employee contributes. So for example, if one of Apple's employees opens up an IRA and contributes $2,000 to it, Apple Computer would also have to match that. They'd have to contribute $2,000 to the IRA too. So it would have $4,000 in it at the end of the year, plus the interest. And this allows, regular working folks to generate a lot of retirement income. If they're willing to open an account and fund it, the whatever they fund it with is matched up to $2,500 a year by their employer, and that's very significant for the way that fund can grow. So over 10 years or 15 years, the employee could really have a significant amount of money in these accounts, which would be, I say supplemental because they would be in addition to like Social Security for most folks. Now, I'm not making this mandatory. I mean, an employee could choose not to have a retirement account. In which case, though, if they don't, then the employer doesn't have to contribute. And on years where employees, even if they have a retirement account, on years where they don't contribute, the employer also doesn't have to contribute. And if the employee does have an IRA and they put $5,000 in it, the employer only has to match to $2,500. So the employer wouldn't have to put in $5,000. Now, our businesses, in addition to the regular business tax, they're also going to have to pay a payroll tax. So remember when we talked about European countries, that European countries tend to have a social, a social investment account, social investment tax, or medical tax, or whatever that they use to fund their healthcare insurance for everybody, or generous leave benefits or retirement benefits or free education or whatever. So we also have that. That's not unique to Europe. The United States has that tax because in Europe that tax takes the form of a payroll tax, which is split between employers and employees. So in Europe, that social insurance tax essentially can go up to 40%. In most European countries, about 20%. But employers have to match that. So whatever payroll the employer has, then it has to take 20% of that and give it to the government. So for example, if the employer is paying collectively all of its employees $1 million a year, then it has to give the government $200,000. And the employees who collectively are earning $1 million a year are going to have to give the government $200,000 of their $1 million. So like if I earn $100,000 a year at that business, $20,000 of it of my income goes to the government to pay for the social insurance programs, like everybody getting medical insurance. That's paid for. So folks in Europe, when it comes to medical insurance, they get government insurance, and they don't have to pay for the government insurance as a monthly fee because their taxes, their payroll taxes, are paying for that insurance. So they get the insurance, they don't have to pay anything for it. other than the 20% of their income that they're paying for it. So a payroll tax is just a tax on wages that doesn't apply to anything else. So things like investment income, capital gains, those don't pay payroll taxes. You don't take payroll tax out of that stuff, just out of wages. Again, kind of unfair, but I'm not going to be changing that. I'm only going to be changing the amount. So currently in the US, we do have payroll taxes. We have like a 6.5% per person, per employee FICA tax, which pays for Social Security. So Social Security, which offers a retirement benefit, is paid for by working people. The FICA tax that working people pay out of their wages. That tax is also matched by the employer. So it's a payroll tax where the employer pays the tax and the employee pays the tax. And we also have a 1.5% Medicare tax. Again, it's 1.5% for the employee and 1.5% for the employer. So if you add those up, 6.5% essentially plus 1.5%, we get about an 8%. We have about an 8% payroll tax for individuals and a matching 8% for businesses. So if you add those up, it's 16% essentially. That's paid to the government. So out of all wages, the government gets 16% of those wages, split 8% from the wage earner and 8% from the wage giver. I'm going to raise that a bit to 24% because the amounts that we pay now are not enough to cover the system. We don't have enough workers anymore to cover Medicare payments, which is health care for the elderly, and FICA, which is Social Security for the elderly. So the way we are now, we don't have enough young people to pay, enough to take care of the elderly folks, their income, their health care with that kind of tax, when it's only 8% for individuals and 16% total. So I'm bringing it up a bit to 24%. Split 12% and 12%. So 12% to fund health care and Social Security. Ideally, I'd like the health care to be health care for everybody, like Medicare for all. But currently, it would be Medicare, Medicaid, Social Security. Now, 12% of gross income, 24% total if you include the business side of it. That sounds like a lot, but actually it's still not enough to fund things like this. But I would hope that combined with other things like increased business taxes, that we're now getting more to a break-even point. So again, the payroll tax would go up from 16% combined to 24% combined. This would reduce the take-home income of people at the lower end of the scale. So this is the one tax that I put in here that does reduce income for people at the lower end of the wage and income scale. But there are a lot of other things that decrease their taxes, so I'm hoping that they would still end up ahead if you combine all these taxes together, all these tax changes together. And this would be also a business obligation. So the businesses would pay taxes on their total gross income, on their investment earnings, and then also they'd pay a 12% payroll tax to the government. Okay, so that takes care of businesses. Now let's go on to estates. So right now we have an estate tax, but it only applies to estates above $15 million to $30 million. Again, it depends on who's giving, the estate. Is it being given jointly or is it being given individually? But estates are what changes hands at death, and the estate tax is actually the tax on the estate, which is paid by the estate. Okay, keep in mind, estate taxes aren't actually technically paid by beneficiaries. They're paid by the estate before the beneficiaries see any money. The money the beneficiaries get is what they get from the estate after the estate pays off the estate taxes and any other taxes that it owes and any other debts that it owes. So, estate taxes were sort of the original tax in the United States before there were income taxes and a lot of other taxes, before there were business taxes. There were estate taxes. And, a lot of European countries get a lot of revenue from estate taxes because they have much lower deductible than we do. Our deductible currently is $15 to $30 million, which means you can leave an estate of $10 million to your child or children, and they don't have to pay a dime in estate tax. Nothing. It transfers free. So I'm dropping the estate tax deductible back to what it was before we went to this current crazy $15 million valuation. Now it's back down to $5 million, which is actually where it was before it went to the 15 and 30 million. I wouldn't change the way we calculate net estate values. Basically, it's the value of each thing in the estate minus what's owed on that. So, for example, if you have a home, that's valued at the time of death at $4 million, and you still have a mortgage on that home, and you still owe $2 million on that home, then for the purposes of the estate, the valuation of that home is $2 million. So it's a $2 million home, not a $4 million home, because $2 million is still owed on it. But if the home is paid off at the time that the person dies and leaves the home, then the estate valuation of the home is $4 million, if that's what it's worth currently. This doesn't take into account, estate values do not take into account equity. So we don't look at equity when we look at estate values. We just look at what the thing is worth at the time of death and how much was still owed on it. So for the purposes of valuing an estate, we're going to do also as we do now, which is we're going to include the collectible items and the transportation items if they're worth above a certain amount. So vehicles like boats, cars, planes, collectible items like jewelries or coins or antiques or artworks. If there are individual pieces or individual items here that are worth above $10,000. Now, if there's nothing worth, if I get a whole bunch of stuff from my parents, I get computers and I get an old car and I get some clothes and some, not too valuable jewelry. If none of those things individually is worth over 10,000, we're just not going to calculate them. They're not going to be included in the estate value. So essentially, the estate value for all the transportation items and collectibles is going to be zero. But we're still going to, look at houses, if I get a house, also stocks, bonds, all those things. So essentially, bonds are counted as cash, as are CDs mostly. So when you calculate estate value, the value of the bonds, the value of the CDs, the value of the cash, the value of the home minus whatever's still owed on the home, the value of stocks minus still what's owed on stocks. So, for example, some people use borrowed money to buy stocks. So for the purpose of valuing stocks in an estate, you look at the value of the stock when the person died on the day of their death, and then you subtract whatever they might owe on a loan they used to purchase the stock. So if they purchased the stock with borrowed money and they still owe $10,000 in borrowed on borrowed money, then you're going to subtract the 10,000 from whatever the stock is worth. But if they bought the stock just with their own money and they didn't borrow anything, then it's the total value of all the stocks that they owned on the day that they died. That's the estate value, regardless of whether the stocks went up or down in their lifetime. So again, this isn't capital gains that we're talking about here. This is just the value of the asset minus whatever is still owed on the asset. And for collectibles, it's just the value above 10,000. Well, the value of each item that's above 10,000. If none of the items are above $10,000 in value, then the transportation items and collectibles essentially have a value of 0 for the estate. Okay, so big change here is just dropping the deductible back to 5 million. By the way, 5 million, there's less than 1% of estates are valued over $5 million. Well, maybe about 1% of estates are valued. So that means 99% of people who die, 99 out of every 100 people who die in the United States have an estate worth less than 5 million, which means that their estate is going to have to pay no federal tax, no estate tax. Only about 1%, 1 out of every 100 people who die, their estate's going to be big enough where it's going to have to pay an estate tax if we set the deductible at 5 million. Okay, now that's one change. Here's the big change, though. That's really not the big change. The big change is the second thing. We're not giving beneficiaries a stepped-up basis. So what is that? I know a lot of you have no idea what that means. Here's the way things are done. What does that mean? Stepped-up basis. So if I sell a capital asset like a home or stock, then I may have to pay capital gains tax. If the home went up in value from the time I bought it, if the stocks went up in value from the time I bought them to when I sold them, then I have to pay tax on the difference. Currently, it's about 20%. So for example, let's suppose I own a home that's worth $4 million. I sell it for $4 million. I bought it for $1 million 20 years ago. Okay, so my profit from the sale of the home was $3 million. That was my equity in the home, which I got. We're assuming the home is paid off. Okay, so I bought a home for $1 million, I sold it for $4 million, my profit was $3 million. When I sell the home, I have to pay capital gains tax on the $3 million, which is 20%. So 20% of $3 million is $600,000. So when I sell that home for $4 million, I'm going to have to pay $600,000 to the government. That's the capital gains tax on the $3 million profit I made on that home. Same thing with stock. If I buy stock and my total purchase price for all those different stocks that I buy, let's say was $100,000, and then I decide one day I want to sell all my stock, so I sell it all and I sell it for $200,000. Okay, well, I've made $100,000 profit on that stock, 200,000 minus the 100,000 I bought it for. So under current law, I owe the government 20% of that 100,000 profit that I made, so $20,000. I'd have to pay, when I sell the stock for 200,000, I have to pay 20,000 to the government as a capital gains tax. Okay, so capital gains tax, whenever you have a capital asset like stocks or homes and you sell them, if you sell them for more than you bought them for and you don't owe anything on them, then you have a capital gain and it's going to be taxed at 20% if you've held the asset more than a year. Okay, now that all changes when you inherit something. If I inherit property, if I inherit stock, and then I decide to sell it. Okay, so I inherit a home worth $4 million at the time that my parent died, who left me the home. Now, I didn't buy the home, they did, for $1 million. But I inherit the home, and it's worth $4 million when I inherit it. That means the purchase price is reset at inheritance to what it would have been on the day that my parent died. So on the day my parent died, if we had sold that home, we would have gotten $4 million for it. So its value at the day of death is $4 million. That means its purchase price, for my perspective, for the purposes of capital gains tax, is $4 million. That's what's called stepped up basis. We step up the purchase price level of a capital asset to what it's worth on the day of death when it's passed on to beneficiaries. So let's suppose I inherit my father dies, and then a few years later my mother dies, and she leaves me her house. And they bought the house for $1 million. But when she leaves it to me, it's worth $4 million. Now, if she had sold the house before she died, she would have owed $600,000 in capital gains tax on it, because she would have sold it and made quite a lot of money. Her profit would have been $3 million. But she left it to me instead. So its sale price, essentially, its base price, its purchase price, from my perspective now, is $4 million. That's what it's worth on the day she died. So if I turn around after the probate is over for the estate, and I turn around and I sell the house right away, and I sell it for $4 million, I get to keep all that $4 million. I don't have to pay any capital gains tax, because the purchase price was reset to $4 million when she died and left the house to me. That's what it was worth when she died. So that resets the purchase price to $4 million. I sell it for $4 million. $4 million minus $4 million is zero. So essentially, legally, I made no capital gains, which means I don't have to pay any capital gains tax. So this is a huge benefit for beneficiaries, this stepped up basis. Enormous benefit for beneficiaries. It means beneficiaries can inherit huge amounts of wealth and then turn around and sell that wealth and get a lot of cash, and they don't have to pay any federal tax, no capital gains tax. Even though technically they got all these things for nothing, and then sold them at an enormous profit, they pay no capital gains tax. Okay, so I'm getting rid of that rule. And I'll tell you why in a minute, but I'm getting rid of that rule. No stepped up basis for beneficiaries. However, I am going to limit the tax that they have to pay. So instead of paying a 20% capital gains tax on the capital gains, they only have to pay a 10% capital gains tax on the capital gains. So if, in this case, if I inherit the $4 million house from my mom, but she only paid $1 million for it, and then I turn around and sell it, the house, we do calculate the capital gain back to the point at which she bought it. So $1 million, what she paid for it, I'm selling it for $4 million, so the capital gain is $3 million. But now I have to pay a flat, if I sell the house, I have to pay a flat 10% tax on that equity, just on the equity. So that would be 10% of $300,000, or 10% of $3 million, which would be $300,000. So if my mom had sold it, she would have had to pay $600,000, 20% capital gains under current rules. But under my rules, we only have to pay 10% of the capital gains, and so $300,000 instead of $600,000. So I sort of split the difference here, essentially made the capital gains half of what they are now for inherited wealth. But I got rid of the stepped up basis, which allows people, particularly rich folks, to get away with not paying any tax on stuff they inherit and then sell. So why did I change it? Oh, I also changed the flat tax amount for inherited wealth above the deductible. Currently, inherited wealth above the deductible, there's a 40% tax on that, which is a large tax. Gives rich folks a lot of incentive to try to shield their money through inheritance trusts. There's a bunch of different kinds of trusts. It's very complicated, which you can set up to shield some of your money from an estate or inheritance tax, but not going into that because the taxes are so high. It's 40% above the deductible amount. So, for example, under current law, if I leave a $50 million estate to my child, they can deduct $15 million, but that leaves $35 million taxable, and the tax is 40%. Now, that's a lot of money, so that's going to be $14 million in tax payable after the estate is settled. So 14 million out of 50 million, that's a lot, a big chunk in tax. Almost 30% of the value of the estate. So what I did here is I, again, split the difference a little bit. I lowered that tax rate slightly for amounts above the deductible to 35%. But of course, now there's a lot more subject to that 35% because I lowered the deductible significantly. Rich folks, though, they, like somebody with $50 million, might try to get away with lowering that tax, that $14 million tax bill for their beneficiaries significantly by shielding some of that money in various kinds of trusts that you can use to remove estates from taxation. And this, again, this is too complicated. This is one of those things like private equity investment. Too complicated to get into in detail. But I'm going to take those away. And I'm going to lower the flat tax rate a bit. But I'm also lowering the deductible. So more of a wash there. And I'm taking away the stepped up basis for beneficiaries. Okay. So why? Why am I doing this? Well, this is one of the main ways that rich people get away with not paying any taxes. Some of you may have wondered, you may have heard a lot that rich people get away with not paying taxes. How do they do it? How do rich folks who are worth maybe $100 million get away with not paying taxes? How do rich folks who are worth billions of dollars get away with not paying taxes? And I'm going to tell you their secret, okay, the way they do it. And part of it involves taking advantage of some inheritance rules. But I don't know if you've ever heard this. If you're more my age, you probably heard this more. Steve Jobs was the founder of Apple Computer. And, Apple Computer became an incredibly successful computer company, makers of the iPhone and the EarPods and all that. So Steve Jobs in his lifetime paid very, very little tax. And a lot of years he paid no federal tax at all, even though he made tremendous amounts of money. And he used to make a big show every year of saying that he was only taking a $1 a year salary from Apple Computer. So the company that he founded and that he was president, CEO of, he, very famously, and he would always show this off, he would take a $1 a year wage from the company. So the wages that Apple Computer paid him, $1 a year. And, you'll hear a lot of other CEOs say that kind of stuff now. And you might think, wow, they're being so generous, only taking a $1 a year wage. But of course, they're not being generous. What they're doing is getting out of paying taxes because wages are heavily taxed. If you make a wage above a certain amount, it gets taxed. And if you make a large wage, it gets heavily taxed, up to 37% currently. That's more than a third of it going to taxes. So rich people don't take their wages as wages. They don't get paid in wages because wages are heavily taxed. And rich people don't like paying taxes. So rich people don't get their wages in money. They get their wages in stock or stock options. So Steve Jobs didn't get paid in cash by Apple Computer. Steve Jobs got paid in stocks and stock options by Apple Computer. And he got, I think, maybe 500,000 shares a year. That's how he was paid. Now, what's the advantage of being paid in stock? Why is that better than cash? Well, because stock is an equity asset, which means you don't get taxed on it until you sell it. If you don't sell it, there's no tax. So if you figure Apple at $100 a share, let's say, and Steve Jobs gets 500,000 shares a year, that means his actual income from Apple is $50 million a year. He's getting $50 million worth of stock every year, because 500,000 shares at $100 a share is $50 million. So $50 million a year in stock, that's a lot of money. But what's his tax on that? His tax on that is nothing, zero, because stocks are capital assets. They are not income for the purposes of current income tax. Personal income is cash, it's interest, but it's not stock or housing, right? Those things are equity assets, and you only pay taxes on them when you sell them. So here's Steve Jobs getting $50 million a year after year in stock, and he pays no tax because he's not selling the stock. He's just collecting the stock. So every year his net worth goes up by $50 million plus whatever the stock appreciated, and he pays no tax. No tax. Now, he would pay tax if he sold it. And I know what you're thinking. You're thinking, well, wait a minute. There are things that you might need to buy, like normal living expenses, that you can't pay for in stock. You'd have to cash out some stock in order to pay for it. Like if you want to buy a house, you have to get some cash to put down on the house or to buy the house outright. If you, and just basic living expenses, like you can't use Apple stock to buy, meals out or groceries at the grocery store or a new car, or a trip to Bermuda, right? Rich people have regular expenses. You know what the truth is, though? Rich people do not tend to spend more than about $2 million a year in cash. That's usually about the most that they spend. And a lot of rich people spend a lot less than that because, there's only so much you really can spend. I mean, how many trips can you take a year? How much grocery can you buy a year? How many meals can you get? How many new houses do you want? Rich people actually don't spend all that much compared to what they earn. Steve Jobs is earning $50 million a year, which he's taking in stocks. $50 million a year. He's not going to be spending $50 million a year unless he decides to buy another company. But in general, Steve Jobs' living expenses are going to be way lower than that. He's only going to need maybe $1 million a year, maybe $2 million at most in cash. So don't you get taxed on the stock when you cash it out? And the answer is yes. So if Steve Jobs, say he needs $1 million to get through the next year and he needs $1 million in cash in the bank. So he could sell $1 million of his stock. That would be easy to do, right? He sells, he sells 10,000 shares at $100 a share, and he's got $1 million. So, of the 50,000 shares that he gets every year, if he sells, 10,000 shares, then he can get the money that he wants. Or that 500,000 shares that he earns, he gets to just sell 10,000 of them to get the money he wants for the year. But the problem is that $1 million that he gets from selling the stock, then he'd have to pay capital gains tax. And so he'd owe 20% of that. He'd have to give the government, if he took out $1 million in stock and he cashed it out, he'd have to pay the government $200,000. That's a lot. So rich people don't do that. The stock they get paid in, they never cash out, not even to get the cash they need to live day to day. So what do they do instead? What they do is they borrow the money from a bank. So if Steve Jobs needs $1 million to get through the year, he borrows $1 million. Will the bank loan him $1 million? Of course the bank will loan him $1 million. He's worth $1 billion. $1 million is nothing. It's, 1/1000th of his net worth. It's nothing. So if the bank loan him $1 million, if he goes into a bank and asks for $1 million, yeah, happily they will loan him $1 million. And what's even nicer is they won't charge him much for it. He'll only get charged like maybe 5% or 6%. At most, maybe 7% for that $1 million, because he's good for it. There's no way he's not going to pay it back. He's a very, very safe bet because he's worth a whole lot more than that. And he's borrowing against his stock assets. So if his total stock assets are $500 million or $1 billion and he only wants to borrow $1 million, that's nothing compared to the collateral he has. So banks are happy to loan him money, and at low interest rates, because he's such a safe bet. So Steve Jobs wants $1 million. Instead of selling $1 million in stock, he borrows $1 million from a bank, just in cash. And he borrows it at, let's say, 5%. So the only thing he loses is 5% of that $1 million, instead of losing 20%. He would have lost 20% if he just sold the stock to get the $1 million. Then he has to pay capital gains, loses 20%. But if he borrows the cash, he only has to pay back 5%. So from his perspective, it's give 20% of the money to the government or give 5% of the money to the bank. And most rich folks prefer to just give 5% of the money to the bank. It saves them 15%. So in that case, it would have saved Steve Jobs $150,000 for that year to borrow from the bank instead of selling his stock. And the money you paid back to the bank isn't paid to the government. We don't have to pay taxes on money we borrow, right? So he doesn't have to pay any of that money back to the government. He has to pay 5% to the bank. So Steve Jobs can go his whole life, collecting stock as his wage, not paying any tax on it because he's not selling it, just collecting more and more and more stock. His net worth goes up and up and up. He pays no tax. And then for the cash he needs every year, he just borrows it from a bank. And he pays 5% on that, and he pays it to the bank. And because it's a loan, he doesn't have to pay any tax on it to the government. So no tax on his cash borrowing, no tax on his income. He can go his whole life without paying any federal tax at all. Now, when he dies, he leaves it to, he's got to leave all this stuff to somebody, right? He actually left it all to his wife, the woman he was married to when he died, and husbands and wives can transfer all of their assets at death without any estate tax. So his wife got everything without having to pay an estate tax. Now, eventually, his wife will die and she'll probably leave a significant portion of it to their daughter. Well, Steve Jobs' daughter. And then the estate tax is going to come in because it's going to be a multi-billion-dollar estate. And even with the estate tax exemption of $15 million, that's still a lot of tax. But like I said, there are trusts that can be set up for children that can shield a fair amount of that money from estate taxation. I'm not going to get into how, and it's very complicated. But just trust me, it can be done. So, even if the wife leaves $1 billion or $2 billion estate, let's say, to the daughter, if she wanted to, she could shield a fair amount of that using certain kinds of trusts. It would limit the amount the daughter could take out, those trusts, but, at any given year, let's say, but a lot of it can be shielded. Okay, and then, of course, the daughter, if she decides that some of that stuff she inherited she wants to sell, so she's got some cash, because of stepped-up basis for beneficiaries, she's a beneficiary, she could sell $1 billion worth of stock and not pay a dime in tax. because it's inherited wealth. And she uses the stepped up basis. If her mom leaves her $1 billion in Apple stock when she dies, and then the daughter turns right around and sells the Apple stock, she's probably going to sell it at about the amount it was valued at when the mom died. And so there'll be virtually no estate tax. And maybe if the value has dropped a little bit, there won't be any estate tax at all. So here you have what's called dynastic wealth, which is wealth that's passed on from generation to generation, without being significantly taxed, except maybe the estate tax, which is only a one-time thing. Okay, but rich people, and a lot of them do this, they get paid in stock. They never cash out the stock, so they never pay a capital gains tax. They borrow the money they need to live on, and they don't pay any tax on borrowed money. So a lot of rich people go through their whole adult lives and never pay a dime in federal taxes. Then they leave their, stuff to somebody else. They have a big deduction of $15 million. They shield as much as they can using special trusts, and then pass on their fortune. Now, there may be a significant estate tax depending on that fortune, but then when their children are the beneficiaries, and when whatever they get that's left over from the estate tax, they can then do anything with, sell it, keep it, whatever, and they don't have to pay any federal tax on it either because of the stepped up basis. So you got 2 generations not paying any tax except for that one-time estate tax on this dynastic wealth, this wealth earned by one generation that's now being spent by another generation. So that's a big way that rich folks get around paying taxes, and they can get their children around it using the stepped up basis. So that's one of the reasons I want to get rid of the stepped up basis, is so the children of rich folks are going to have to pay some tax if they sell the capital assets they inherited. And so how are we going to get around the first part, which is rich folks getting paid in a equity asset and then just not selling it, so they never owe any taxes on it? That's a tough one, because you can have a net worth of billions of dollars and not owe any tax at all, and never pay any tax on it. So, and the way you do that is you use these equity rules, which lets you get around that. So what a lot of people have thought of as a way to stop that, essentially, is to institute a wealth tax, which is, instead of getting taxed just on your income and what you earn selling equities, you're taxed based on your total net worth, regardless of what form it's in. Now, a lot of people, like in California right now, they're proposing a one-time wealth tax for billionaires, where just this 1 year they're going to have to pay like a 5% tax on their total net worth, as opposed to on what they've earned or what they've gotten by selling equities. But I would like to make a tax that could be ongoing, so it isn't like a one-time, one-off thing. It would be an ongoing, regular tax that would be more of a wealth tax than an earnings tax. And this would only hit really people who are rich. It would have a high deductible, and it wouldn't, for most people who aren't rich, it wouldn't significantly hit them until maybe if they sold, or if they owned a home that had gone way up in value, then they would get hit with this tax. But otherwise, it's really just a tax on rich folks. But it's an ongoing tax. And so here's my idea. My idea is to institute what I call an unrealized capital gains tax. Okay, unrealized capital gains. So generally, a capital asset like a stock or a home, you only pay taxes on it when you sell it. Now, there's a good reason for that. And the reason for that is if you had to pay taxes on it when you didn't sell it, you might not actually have the money to pay taxes on it. Presumably, in the year you sell something, you have a lot of money because you got the money from the sale. And so you can use some of that money to pay a tax. But if you're taxed on something that you're not actually selling, you may not have the cash lying around to pay the tax. And I admit that's a real problem with any kind of wealth tax, really, but particularly with an ongoing wealth tax like my unrealized capital gains tax. With this, you get taxed on capital gains that you would get if you sold the asset this year. But you get taxed on it even if you don't sell the asset. So, and this would be a tax that would be on the regular income tax scale. So it would be an up to 40% tax. It would have its own higher separate deductible of $150,000. And actually, I would probably increase that, again, because this whole tax is a trap for people who really don't have a lot of money, but who have a home that's worth a lot now. And normally they wouldn't have to pay any tax on the home until they sold it. But under my system, they might have to pay a tax on it when they're not selling it, and somebody who's otherwise not worth a lot of money would not have the money to pay that tax. And so to protect them, I might institute a much larger deductible than $150,000. But for now, let's say it's $150,000. Okay. So the only things that would be subject to the unrealized capital gains tax would be property and equity investments like stocks, stock funds, private equity. Again, a lot of rich people do private equity. You won't find many middle-income people doing private equity investments. Mostly because private equity investments usually require a fair amount up front. You have to pay a lot just to buy into it. So you have to be worth quite a bit to get into the private equity business. But a lot of rich folks do that. They have a lot of private equity investments. So we say private equity investments, we say stocks, stock funds, we say property, and we're going to add in crypto because these are new things now. Crypto, unrealized precious metals. So crypto and precious metals. And so what's going to happen here is at certain time intervals, you're going to be taxed on the value of these things, the equity you have in these things, regardless of whether you sell them or not. Now, you could choose to sell them, in which case it would be a realized capital gain, not an unrealized capital gain. And it would then go into the realized capital gain box, which has a lower deductible. So the way we're going to do it here is the unrealized gain on stock values, stock fund values, private equity values, those are done every year. So every year, if you own any of these things, you're going to be taxed on unrealized gains on those things. And again, unrealized gains is when you don't sell them. So let's say I own a bunch of stocks, and from last year to this year, they've gone up in value, but I'm not selling them, I'm just holding them. Well, this year I still have to pay an unrealized gain on the equity from the previous year. So just in the last year, what was the increase in value from the end of last year to the end of this year? And that's what I'm going to pay the unrealized gains tax on. So let's say I own stock that last year was worth $300,000, and the end of this year it's worth $400,000. And that's the only capital asset I have is just that stock. So what tax do I pay? And the answer is no tax, because there's 150,000 deductible. So you had 100,000 in unrealized gains, but the deductible for that is 150,000. So you pay no unrealized gain tax, even though your investments went up $100,000. So again, the stock stuff is retaxed. Is we look at unrealized gains every year. The private equity valuations, a lot of people have private equity accounts. They have valuation statements that they get at the end of every year. And so we compare last year's valuation statement with this year's. If you haven't held an investment for a year, then for private equity, we just use the first year as the base, and we don't tax it, and then you start the tax starting the second year. And for stocks, we just use the purchase price during the year as the valuation for the end of the year. Okay, now here's the big problem is real estate. So stocks, capital, and private equity investments taxed every year based on the end of the previous year's valuation to the end of the current year's valuation, but with 150,000 deductible. Now real estate. This again is a problem because we've had this big real estate boom where housing valuations have gone up a lot in a short period of time. And a lot of people hold on to their real estate, particularly their homes, for a long time, 20, 30, 40 years. My mom just sold a home that she'd owned for 50 years. By the way, she only lived in it for like 15 years. And then after that, she moved out, but she kept the home and used it as an investment property. She had renters in it and collected the rent. And she did that for 35 years. So she actually owned the home for 50 years. Now, in 50 years, the value of her home went up from $55,000, which is what she bought the home for, to $1.5 million, which is what it's worth today. That's what she ultimately sold it for. And that's an enormous increase. And so, if now she was able to pay that, she owed a lot of capital gains tax on that home when she sold it. If she was able to pay it because of the sale price. She paid it out of the sale price, right? So she had the money. But suppose I have a home that I've owned for 30 years and its value has gone up from $50,000 to $1 million. And suddenly you're hitting me with an unrealized gains tax. So now I have to calculate the value of the home, the equity on the home, and it's $950,000. And I've got to add that to my regular income. So I owe a lot of tax, up to 40% on $950,000. And I don't even have any cash on me because I haven't sold the house. So ouch, you're killing me with that. And so here's what I propose with real estate. And again, one of the things I might propose is to change that deduction to something much higher so that, you really can make it so it only hits rich people. The nice thing about deductions, I'm a big fan of these deductions off the top for taxation purposes because you can really control how much of a tax affects poorer people versus richer people just by changing the deductible amount. So deductions are a good way of controlling that and regulating that, the percentage of the tax that hits rich people versus poorer people. So, for example, I would be open to raising the unrealized capital gains tax up to like 500,000 or maybe $1 million. And in that way, the person whose home went from 50,000 to $1 million wouldn't have to pay any unrealized gains tax. But in order to make this work, you have to reassess the real estate values even if the property is not sold. And trying to reassess property values every year with all the properties that are owned would be an impossible task. There aren't enough assessors to do that. So what I say here is for the purposes of this unrealized gains tax, you only reassess properties every 10 years if they're unsold. If they're sold, you reassess them when they sell. But if they're unsold, you only reassess them every 10 years. And then in the years between the assessment years, you don't owe any additional unrealized gains tax. So you calculate the unrealized gains tax just for the assessment year, and then for the next 9 years, you don't reassess unless there's a sale. And so you don't owe any additional unrealized gains tax. And because there's theoretically 9 years in there where you're not paying any additional unrealized tax on that property, you can split up the tax payments for the property over 10 years. So this is the one time I'm allowing people to split up their taxes owed over multiple years, is for the purposes of unrealized capital gains just on real estate. You can pay it off over 10 years without interest. So let's suppose I have, an unrealized increase of property value of $1 million, and I'm going to owe in tax on that, let's say $250,000 in tax or $300,000 in tax on that $1 million. So I can take that $300,000 in taxes that I owe, in unrealized gains tax that I owe, and I can spread it out over 10 years. So that means adding $30,000 a year to my tax bill instead of adding $300,000 to that 1 year. And let's see, yeah. So again, you only have to pay this when you're talking about property, you only have to pay it once every 10 years, and you don't reassess in between. But you also have to, you also have to use the sale year as a base year, the year you bought the house, and then the final year that you sell it, you do have to pay the gains going back to the last time it was reassessed. So let's say I buy a house and then I sell it in 5 years. Well, then I just pay realized gains because I've sold the house. So when you sell the house, you pay realized gains, not unrealized gains. And in that case, I pay the realized gains going back to the 5 years earlier when I bought the house. But let's say I buy a house and I hold it for 15 years and then I sell it. Well, then I pay the realized gains, but only when I sell it, but only on that 10-year valuation amount. So the first 10 years after I bought it, I do have to reassess it. And then I pay unrealized gains at that 10-year mark going back to the original purchase price. But then when I sell it 5 years later, I pay realized gains going back just to that 10-year reassessment, not to the original purchase price. I hope that makes some sense. So remember, when you actually sell the asset, you're not paying unrealized gains, you're paying realized gains. That's up in the other column with a $50,000 deductible. The unrealized gains have a higher deductible. And you have to do that every 10 years, starting with when you purchase the home. So if I purchase a home in 2025 and I haven't sold it yet, I have to pay unrealized gains in 2035. And then I still don't sell it. I have to pay unrealized gains again in 2045. And then I sell it in 2050. Then I have to pay realized gains in 2050, but only with a valuation going back to the base year of 2045. Okay, so again, this is going to be a problem with this deductible. It's going to be a problem for people who aren't rich, except that they have a home that dramatically increased in value, but otherwise, because they've stayed in it for a long, long time, but otherwise they're not rich. So those folks are going to get hit the first time they reassess. So if this goes into law, let's say, and I've been living in a home for 30 years, then I'm going to have to reassess it right away as soon as this law goes into effect. And I'm going to owe 30 years worth of, tax on 30 years worth of appreciation, even though I'm not selling the house. So that's going to hit me hard. And the only way to really get around that, aside from the fact that I'm letting you spread out the taxes owed over 10 years, the only way to get around that for poor folks who don't have much money is to dramatically increase that deductible, to take it up to like $500,000 or $1 million instead of leaving it at 150,000, which I'm agreeable to. Yeah, I just put this in as a number. Okay, and going down here, just making clear that private equity is included in this unrealized gains tax. Okay, so what's the point of all this? Of instituting a brand new tax that we've never had before, an unrealized capital gains tax, where you're taxed on a capital asset that's been appreciating, but you haven't actually sold yet. So that's essentially a wealth tax. It's a tax on how much you're worth, not how much you got in that particular year, how much you earned or made. Okay, and by the way, this tax does not include things like collectibles or vehicles. Those are exempt from these unrealized capital gains, just because to put those in would be too unwieldy. Plus, again, things like vehicles tend to depreciate, not appreciate. So they don't tend to give you any capital gains. Okay. So why did I put this in? I put it in so that rich people can't do what like Steve Jobs did. They can't just take their income as an equity asset, like take their income in stock, and then never sell the stock and live on borrowed money, just to avoid paying federal taxes. So if you institute this capital gain, this unrealized gains tax, you can't get out of it. If I get paid in stock, I have to pay the capital gains tax every year, starting a year after I got the stock. So, the first year I get paid in stock. At the end of the year, I calculate a theoretical gain for the stock back to when I first got the stock. And I have to pay tax on that. That's an unrealized capital gain. I didn't sell the stock, but I still have to pay this tax on the unrealized gain, assuming the value of the stock is more than the deductible, or the equity that the stock has gained is more than the deductible. Okay, so the whole purpose of this tax is so rich people can't get away with not paying any federal tax, which a lot of rich people do. Okay, they pay virtually no federal tax because they get paid in equity assets, which they never sell. They just leave them to their kids. So it's never taxed until the estate tax kicks in, and that's not until after they die. So in their lifetime, they pay no tax on any of this income. And they can end up making billions in stock and pays no tax on it at all, ever, until after they're dead. That's not fair. It's not fair. Lots of people who they employ are earning wages that they have to pay taxes on every year. But the boss, the CEO, is not paying any tax, even though they're earning billions, ultimately. So not fair. This tax takes care of that. It's essentially a wealth tax. Tax on, your unrealized gains, the equity that you've earned, but you haven't yet cashed in. So this tax should bring in a lot of money to the federal government, because you're taking a lot of people who are paying essentially zero tax now, a lot of very rich people paying essentially, and you're making them pay taxes every year, and significant taxes too. And by the way, I don't know if you noticed it or not, but I put in a caveat about outshoring business income. A lot of businesses these days get away with not paying tax because they take their most profitable divisions, like for Apple, it's the iPhone division, and they reincorporate them in low tax countries so that they're no longer American They're a foreign subsidiary of the original parent company, and they're now located in some foreign country where there's essentially no federal tax or very little federal tax, like Ireland or the Cayman Islands. And all the business has to do is file some paperwork and set up an office with a few employees in that tax haven. And that's just no bueno there. So I put in a rule, and I didn't show it to you before, I should have, that if a U.S. company sets up any subsidiaries, any foreign subsidiaries, those are also subject to the 10% tax, either on transferred wealth or on earned income. And I would do the same for individuals. So, the bottom line is, if you're a U.S. citizen, you're going to get hit with these taxes, including the unrealized gains tax. And this tax would hit citizens. It would also hit permanent residents, people with residency status and green cards and that kind of thing. So permanent residents and citizens, even naturalized citizens, get hit with these taxes. Okay, so that's it for my proposal. Again, it's got some really radical stuff in it. It's got businesses being taxed on their total income regardless of profit. So we don't even look at the profits of a business, we just tax them based on their gross income. It's got a whole new wealth tax, which in the form of unrealized capital gains, which are calculated on things like stock and private equity every year and on properties every 10 years. It's got increased estate taxes. It gets rid of the stepped up basis for inherited wealth. It treats capital gains as regular income. So it's got all of these provisions which are designed to increase revenue to the government, and particularly from richer folks. Most of these provisions only hit or substantially hit rich people versus, say, middle class folks. Okay, now between all of these, we should solve a few problems. We'll solve a fairness issue. Under these new rules, wealthy companies, big companies, and wealthy individuals will have to pay their fair share of taxes. They won't, unless they just break the law entirely, they won't be able to get around this. So it'll make the system fairer in that sense, that richer folks won't get away with paying virtually no tax. And it will increase revenue for the federal government, which will help us balance out the federal debt so that we don't have the deficits that we do. We're not running, and we may even be able to run a surplus. We may even be able to generate extra money for the government, which could be used for like expanding certain social service programs, or at least keeping them solvent, like keeping Social Security solvent, maybe expanding Medicare, so more people can get it, not just old folks. Or expanding Medicaid, so folks who are less poor can get it. I'm not kidding myself that we'll be able to go to Medicare for all right away. That would involve even more tax increases than we have here, which we could do, like Europe does, but I doubt that that's going to happen in the very near future. Okay, so I hope this made sense to you, and that you, at least, even if you don't agree with a lot of these taxes and you think they're really bad ideas, that at least you know where I'm coming from, why I put them in, and why they're structured the way they are. And at some point in the future, I'm happy to debate folks about this. And the only thing I would ask you to consider is, if you don't like some or all of these taxes, that's fine. How would you handle the problems? What would you do about rich people and rich companies not paying much tax relative to folks who earn much less? I mean, do you think that's a problem at all? And if you do, how would you address it? And how would you address the federal deficit? $2 trillion a year and growing, and not sustainable at all. Eventually going to really bankrupt the United States. So how would you address that? if you don't like any of these ideas, good. I'd love to hear yours. Okay, so again, hopefully this was very complicated and very long. I hope it made some sense, and I look forward to seeing you in the next pod. Bye.